Let's dive in and simplify what an interest rate swap quote really means.
You know, for any business, floating interest rates are a huge headache. They're totally unpredictable.
All right, let's put you in the shoes of a CFO. You need big money, but there's a catch.
So what's the fix? Well, it's a super useful tool called an interest rate swap. So what is it? Basically, two parties agree to swap interest payments, one's fixed, one's not.
It's a simple trade, really. One side pays fixed to get floating, the other does the exact opposite. Our CFO wants that fixed rate, so they call a dealer and get this. It looks complicated, right?
But don't worry, we're just going to focus on these two key numbers, the bid and the ask. Here's the key. The bid is the rate you receive. The ask is the rate you pay.
Remember, our CFO wants to pay a fixed rate. So which one do they care about? The ask rate.
But what's in it for the dealer? Well, they make their money right here, in the middle.
That little gap between the two is just 15 basis points, or 0.15%. And on a huge deal, that spread is the dealer's profit. Now let's see the final math.
Okay, let's calculate the CFO's all-in cost. It's just a three-step process, pretty simple. And here's the magic. The floating rate they get just cancels out the floating rate they pay. And they're left with a nice, predictable 3.2% fixed rate. Boom, risk managed.
But wait a second. You might also hear about something called the swap spread. What's that about? This is super important. The dealer's spread is their fee. The swap spread is a market indicator.
So there you have it. You now know exactly how to read the critical parts of any swap quote.
Now you can decode the quote. But the real question is, when is using a swap the right move?